Hello, Mr. Ruby. We are four, and today we're going to present our approach and methodology for investing in five stocks listed on Ho Chi Minh City Stock Exchange with the initial capital of 1 billion Vietnam dong. And our presentation will go through four main parts. The first is introduce briefly about the project and portfolio, then describe and provide reasons for choosing its company in the portfolio. The third part is all about return risk and beta analysis. The final one will be the portfolio optimization. Since our group has an intention of investing in stock having low volatility and stable growth, we consider and choose companies listed in the VN30 index, and VN30 is highly appreciated in terms of corporate management and accounts for a major percentage of the market capitalization. So our research strategy is to concentrate on three basic industries: banking, manufacturing, financing, and insurance. In the one industry with high growing potentials, real estate. In terms of good of the mentioned sectors, we look for companies with strong brand awareness, stable and good financial performance, high growth potentials. As a result, we came up with the final watch list of 10 stocks over the period of 7 years from April 2015 to April 2022, as you can see on the slide. And then we calculate the annual average returns and the annual standard deviation on each stock in our portfolio. In our watchlist, plot all the stock risk and returns on the chart. After that, we can pick out 5 stocks with the high return and low risk for our portfolio. So the first stock in our portfolio comes from Factech Real Estate Development Strong Stock Company, which was established in 2004, officially became a public company in 2008. By 2010, the company's shares were officially listed on the Ho Chi Minh Stock Exchange, and Factech core business is residential real estate. In addition, the business had launched the industrial real estate segment. And there's two main reasons we take into consideration for choosing this stock. The first is about the future potential. According to the World Bank, the Vietnamese population in 2020 was over 97 million and is expected to reach 120 million by 2050. So our country is experiencing rapid demographic and social change, which is anticipated to support and the demand of residential real estate industry for the coming years. And according to the IMF, Vietnam, our country GDP growth is projected to grow significantly from over 343 billion USD in 2020 to over 630 billion USD by 2026. So the outlook for the Vietnamese residential real estate market is positive, mainly due to continued strong economic growth, rapid urbanization growth, and the construction for several projects in major cities.
So the second reason is that PTR is the stock that had the highest annual average return in our watch list, meaning investor will receive 40.41% money from PTR sticker with only 31.2% risk that a PTR stock will fail to meet its expected return. While this is still a risk, but for those who are risk taker, PTR would be quite a good choice as it promises the high return accompanied with a reasonable risk. Next, we come to Khang Dien House Trading and Investment. Still belong to the real estate business. The company was founded in 2001 and had operated under the model of a joint stock company since 2008. Aside from the industry potential it has had, the reason why we choose this company is because it had a good financial performance. This can be shown in its financial report, where it generates significant revenue in 2020 and exceeds its profit plan expectation in 2021. And investing in Canadian stock can be a good move when a KDH stock will bring investor 28% money from KDH sticker with a 27.14% risk, where KDH stock fails to meet its expected return. Compared with other stock in our watch list, investing in KDH stock is the next best thing we have to offer. Coming to the bank business, our next choice is Military Commercial Joint Stock Bank. The bank was founded in 1994 and have been listed on Ho Chi Minh Stock Exchange in 2001. The reason we choose this company is stock is because of two reasons. Firstly, it is because of its financial performance. As shown in the slide, the net revenue and net profit of the company had always increased stably throughout the years. This can be explained by MBB's efficient strategies that help them to stay ahead of the game and deal with economic crisis. Secondly, according to our calculation, MBB offers the third highest return in our watch list. Investor will receive an average of 26.14% increase in money from MBB sticker with a slightly higher chance of risk. While the situation is not quite ideal, it is notable that a reasonable return with a relatively small volatility make MBB stock could be taken into consideration when investing.
Next is ACB. According to ACB's website, ACB is one of Vietnam's leading joint stock commercial banks. ACB currently has more than 10,000 employees working in 365 branches and transaction office. It is headquartered in Ho Chi Minh City and on 11,000 ATMs and 850 Western Union agents in 47 provinces and cities. ACB currently operates in a variety of financial and banking fields, including lending, saving, and other options for customers. ACB's credit growth was 9.2% in H1 2021, which was higher than the industry average of 5.9%. Rapid growth expansion with a high quality is as well a reason for us to choose ACB. With the advantage of substantial equity from retained earnings and quick response to the SBV lending rate, lowering requests during the COVID-19 pandemic, ACB is expected to continue to be assigned a credit growth target higher than the industry average in the upcoming years. The second one is that its long-term cost saving can be achieved by implementing digitization. ACB is currently in the process of digitizing operation and reducing processes in order to improve customer experience while lowering the operating costs. Other banks have efficiently embraced digitization, thus reducing staff size, and we expect ACB staff growth rate to be slower than asset growth in the coming years. Next, we move to the VCB. Vietcombank is one of the country's four largest state-owned banks. Originally, Vietcombank specialized in foreign exchange transactions, but since 1996, it has restructured and become a joint stock commercial bank with open business activities that have expanded into retail and institutional bank. Vietcombank was IPO in December 2007 after being equitized in 2007. For its future potential, since 2017, when VCB began implementing a long-term plan to focus on retail credit while gradually reducing the wholesale credit, the percentage of outstanding retail loans in total outstanding loans increased to 53% in 2020. The loan structure modification is appropriate and in accordance with the market demand in the future. By 2035, Vietnamese high and middle classes are predicted to have grown greatly, accounting for about 55% of the total population, which will push the banking industry customer base We expect VCB stock price to expand sustainably in the long term due to the strong brand awareness and effective shift in the credit structure. VCB is a leading bank in Vietnam with the outstanding financial performance. Firstly, Vietcombank has ranked first in value in the list of 25 leading financial brands in Vietnam, announced by Forbes Vietnam in 2021. With a value of 705 million USD, the brand is 2.8 times higher than the value determined by Forbes in 2020 list. In the list, Vietcombank has far surpassed its rivals such as Techcombank, Vietinbank, VPBank, and so on. Furthermore, VCB has the biggest profit before tax in Vietnamese banking industry, growing by more than 100% from about 11 billion Vietnam dong in 2018 to about 23,000 billion Vietnam dong in 2020. Also, VCB maintained a low NPL ratio and high return percent of ROE during the COVID-19 outbreak, demonstrating the company's initiative and operational effectiveness.
Okay, now I will give some comments on the annual average returns of groups portfolio and market portfolio. The average annual amount of cash flow created over the life of an investment is known as the average rate of return. An average yearly rate of return of 10% or above is considered a respectable return on investment for long-term stock market investments by most investors. There will be years with reduced returns or even negative returns. In our work, the annual average return of the portfolio is computed by multiplying the return of each of the 5 stocks in the portfolio by their weight. We assume they are equally weighted at 20% and then summing it all up to get the portfolio's annual average return. Our portfolio's yearly average return, 28%, is significantly higher than the market's 14.62%, indicating that if we invest 1 billion VND in this portfolio, we will receive an average return of 0.2845 billion VND after a year. There are 2 major factors that account for the comparatively high return of the portfolio. The first is that as an initial approach, we concentrate on companies with high returns and solid financial performance that operate in industries with great growth potential. As a result of those equities' high return, the portfolio's average return is similarly high. PDR's remarkable return of 40.41% also contributes to the portfolio's overall strong return. The market's return is relatively low, reflecting the overall market trend. Only a few firms in the market have good financial performance and high returns, but there are many smaller enterprises with low returns or large organizations suffering with their business issues. As a result, the market's return 14.62% is significantly lower than our portfolio's return, which is 28.25%, even lower than the stock with the lowest return. Next, we also computed the total average return of groups portfolio and market portfolio, and we can see that the average annual return of each stock is almost higher than the market's average return. As a result, the portfolio's total average return is always higher than the market's. From 2015 through 2020, observed in the line chart, market and portfolio returns have fluctuated in the same way during the last 7 years, except for the period from 2018 to early 2020. The average return of the portfolio tends to increase and the return of the market decreases significantly, indicating a substantial improvement in the financial approach of the chosen companies. Okay, next we continue with the total risk.
So next, our group will give some comment about the total risk of our group's portfolio and market portfolio. So what is risk in investment? Risk is very important in financial investing for analyzing the performance of securities corporation. And typically, the risk is measured by looking at the past behavior and results, which are measured by variance and standard deviation. Next, let's take a look at the two charts that compare the standard deviation of each stock in our group portfolio versus VN Index, and the comparison between the group's portfolio and VN Index in the period of 7 years. So first of all, as we can see from the two charts, that VN Index has much lower yearly standard deviation than individual stock as well as the group's portfolio. And in the first chart, during 2016 to 2017, 4 out of 5 stocks and VN Index had the lowest yearly standard deviation. However, the PDR standard deviation of that year was still high, and it reached the lowest value in 2019 to 2020. And as we can see from the first chart, ACB was the stock that had the highest peak, which was more than 38%. And also we can see from the second chart that the total risk of portfolio is higher than VN Index, and especially the largest gap is in 2018 to 2019. And next, it is still about the standard deviation. However, it is the average of total 7 years that our groups have analyzed. The yearly average standard of our group's portfolio is 17.66%, which demonstrate that the annual return can fluctuate 17.66% from the mean. And the PDR has the highest annual standard deviation among 5 stocks, which means that PDR is the stock that has the greatest risk. And also, which stock, the more risk the stock have, the more return it will be. So PDR is also the stock that had the greatest return in our group's portfolio. And as we can see from the second chart, that the least risky stock in our portfolio is KDH with 27.14% of standard deviation.
I will in charge of the systematic risk part of the group project. Firstly, we must have a mindset about a beta coefficient. The volatility of a single stock is related to the systematic risks of the whole market using the beta coefficient. And the beta coefficient is also applied in the capital assets pricing model, which is commonly used as a method for pricing problematic securities and calculating estimate of the expected return on assets, and taking into account both assets risk and capital cost. And the systematic risk is measured by using the Excel slope function, which takes the stock historical returns as the first parameter and the market historical return, which is the VNI index, is the second one. And when we get the beta coefficient for the 5 stock, we assume 20% for each of the stock and use the sum product function to multiply them by the weight of each stock to get the beta coefficient for the group portfolio. And from the chart about the beta coefficient of the 5 stocks and the portfolio, it can be seen that every stock in the group portfolio as well as the portfolio itself has a lower beta than the market, and implying that the price of security of our preferred stock are less volatile and risky than the market. Moreover, when comparing the systematic risk of the 5 stocks, the beta coefficient of VCB is the highest, while that of ACB is the lowest. And comparing 5 stock beta coefficient with that of the group portfolio, it can be indicated that KDH and VCB are the 2 stocks that have a higher beta coefficient than the portfolio, and BDR MBB, and ACB are three stocks that have the lower systematic risk than the portfolio. And about the group portfolio systematic risk, the beta coefficient that we have calculated indicate that it is 79.08% less volatile than the market. And all 5 stocks and the group portfolio have a systematic risk is less than 1 but larger than 0. So this shows that this stock and the portfolio are less volatile than the market in theory. Furthermore, each of the 5 stocks contribute to the portfolio risk reduction. However, VCB contribute the most risk to the portfolio, which also indicate that if the market beta coefficient rise, the amount of risk that VCB bring will make a more significant contribution to the portfolio than other stocks, while ACB had the least risk, keeping the portfolio more secure. So next is the bonus question of our group.
So about the last part is the portfolio optimizer. So in this part, we will use Excel solver to calculate the weight of each stock so that can minimize the variance risk of the portfolio. So we again use the same covariance matrix calculate above and the same formula of multiple function to calculating the variance. So once we have the covariance matrix and already set the variance cell of the formula, we open the Excel solver and start the calculation. We set the objective to find the mean for the variance cell that we type the formula by changing the weight of each stock. We also set constraint to each weight to be a positive number and the total of weights equal 1. We then run the Excel solver and get the result. So to sum up, with the support of Excel solver, we can minimize the portfolio variance to 2.98% or standard deviation to 17.24% with higher return and lower risk. To obtain the above results, the percentage of the investment for the group portfolio are PDR 21%, 21.37%, KDH 25.56%, and MBB 11.38%, ACB 26.54%, and VCB 15.16%. And that is also the end of our presentation. So thank you for listening.